What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
Michael, we've had an interesting couple of weeks in the market, and I've really been looking forward to sitting down and talk to you about this. You've had this volatility in software, specifically the mega cap space, that is really garnering a lot of attention, rightfully so, because it is such an enormous weight of the index, while you've seen sporadically all-time highs in other parts of the market. So I'm really interested to get your take on what's going on. What do you see? Is this a harbinger of things to come? Or are we seeing, just idiosyncratic issues playing out in what have been some of the best stocks to own over the last couple of years?
Yeah. There's some weird stuff, some weird data points we're getting out of the market. And I would chalk a lot of it up to the weight concentration in the index today. We've seen this year, I've seen a lot of people post and talk about how the equal weighted index is off to one of the best starts in decades relative to the cap weighted index to start the year. But at the same time, there's been a lot of concern because of what's going on in AI CapEx within areas that are getting disrupted, like the brokers and software stocks. So you kind of have this polarizing market where there's a lot of things that are very bullish taking place. But at the same time, and largely due to the concentration of the index that we just have today, which is historically the most concentrated in history, you've gotten some bearishness taking place because of what's going on in the Mag 7. So it's really interesting because, I think people are latching on to either sides of those stories and not thinking about what the connection between the two of them are. And I would even say that perhaps people are getting more negative than they need to on the outlook for stocks in general because of what's going on in 7 stocks and the impact it's having on the index.
It's understandable. At the beginning of the year, over a third of the weight of the S&P 500 was those 7 names. And because of their crazy outperformance over the last couple of years, you pretty much had to own. The average number of institutional owners, so firms that are involved and have to report on holdings for the Mag 7 stocks, is on average 6,500 institutions involved in those names per firm, while the average for the overall S&P 500 is 700 per name.
Let me get that right. So it's basically a 10-fold multiplier on companies that own the stocks in the Mag 7 on average versus your average stock in the S&P.
Yes.
That's pretty wild. I get it. It makes sense. If you didn't own those stocks in the last 3 years, it was extremely difficult to outperform the market. And it was extremely difficult to outperform the market to begin with, but even more so if you didn't own the big winners, or at least many of them.
Yes. So, given the number of people involved in them, the outperformance, the weight in the index, it's not surprising that seeing the pullback this year is causing a lot of people anxiety.
So the crazy thing is, again, thinking about this kind of tale of two markets, you've got staple stocks. So the XLP, as an example, is up 12.5% this year to date. That's a great year, let alone a great month and a half. And so typically when you see consumer staple stocks outperforming, and just for reference, the S&P, as we sit here, is up about 60 basis points on the year. So they're basically outperforming by 12%. That's typically really difficult times in the market, if not periods where the market's flat out down. And at the same time, you've got the equal weighted S&P up over 6% and the Russell 2000 up about 7.5%. So who do we listen to? Is it staples? Should we get really bearish because of what that is potentially foreshadowing? Or should we look at the glass half full and say, look, small caps are crushing the S&P 500. The average stock is up 6%. The breadth of the backdrop is good. So really kind of is creating this divide for people that look at breadth and look at the market as one, the cap weighted index.
So it's kind of that idea that markets had been so narrow for so long, and we all were wanting and hoping for a rotation. Now we're kind of getting it, but it's very painful.
Yeah. Yeah. And the funny thing is, it's again kind of the opposite of the last few years where, you look at the S&P 500, you look at the NASDAQ, and you're like, the market's doing great. And under the surface, small caps were deeply lagging. Cyclical stocks like transportation names were going straight down. And you had a very narrow market, but people felt great, generally speaking, because the S&P's up, especially on Main Street on a relative basis about the equity market. Now you're getting the opposite. So I think, investors need to be aware of this nuance, and that maybe looking at the S&P index on its own is not really a good indicator of how healthy or weak the market is because of 7 or 8 names.
You put out an interesting chart this week on market breadth. So it was annual market breadth. And that is a chart published over the last couple of years because it was at consistent epic lows. And already barely into this year, the number of stocks outperforming the benchmark is tied for the all-time high in history. It's pretty impressive. Like, it doesn't necessarily feel that way because of what's going on in these stocks that are just, so much of a linchpin of our portfolios.
Yeah. And the good news, again, is from a macro perspective, we are absolutely beginning to see better data in cyclical parts of the economy that have suffered from the Fed's tightening cycle and the inflation shock the most, whether it's small business earnings or small business optimism or transportation stocks, which have been among the better performers this year. You're seeing better data there as well. The ISM manufacturing index finally broke back into expansion for the first time in a long time. So on one hand, this looks like your classic soft landing, but given the concentration and given the focus and just the grip that these AI stocks have on market sentiment and the market, I think it's leading investors to numerous conclusions.
So that's interesting. And that's exactly where I wanted to go with this. From an economic standpoint, you continue to see the green shoots of better data ahead, which economic data, for the most part, translates into earnings, better earnings, broader participation by more stocks. So it's kind of a double-edged sword. We're feeling the pain, but more stocks are participating. And you do see that continuing. That's what your hope framework is pointing out.
Yeah, and the funny thing is this week, Nick Timiraos of the Wall Street Journal published an article midweek, and I'm going to paraphrase, but it's basically like the economy seems to have stuck the soft landing. And so I saw Nick tweeted that, and I reached out to him and asked him what his definition of a soft landing is. And he doesn't have one, which again is kind of a little bit strange to be writing an article about the economy having done something, but actually not defining what that thing is. So we do have a framework for identifying soft landings throughout history. They're very consistent, and they're really about the first 2 letters of my hope framework. It's about seeing better data, and all of this takes place, at least historically, it's always been in the wake of Fed easing. So we got Fed easing. It's been better data in housing and manufacturing. So last year, the MBA purchase index, so one of the most leading and most rate sensitive aspects of housing data, improved 20% year on year. Biggest improvement we've seen since the decline that began in 2022. So that was check for the housing data. And ultimately, that is what gave us the conviction last September to make the call that markets were going to likely broaden and led us to rotate into more value and cyclical areas of the market in terms of what we're recommending. This year, at least to start off January, we got a surge in manufacturing PMIs in the US. The ISM New Orders Index, so the highest, hottest reading in at least 4 years at about 57. The earnings data, to corroborate what's going on in the macro, the earnings data is improving across the board. We're seeing generally better breadth of earnings revisions to the positive side. We're seeing small cap earnings expectations that are rising faster than they are in the large cap space. So there's a very strong fundamental support for why this rotation is taking place and ultimately why we think it will continue. And that is different than any time in the last 3 years where small caps outperformed for 20 or 30 days because we got a good inflation data point. But it never led to any better economic data. So our soft landing framework is screaming that, yeah, we've had a soft landing. And what that means is you want to be positioning more cyclically, more within value. You want to be lower in capitalization, and you want to be outside of the US looking for cyclical exposure in global markets. It also means that you should stop worrying about employment weakness because rarely, if ever, do we see a sharp deterioration in employment data once we have seen housing data and manufacturing data and earnings data start to improve, which is where we would argue we are right now. So, soft landing, yes. Employment, yeah, I think it's going to remain sluggish, and the fears around AI disruption won't go away, but we are unlikely to see the unemployment rate move much higher here. Now, the silver lining of continued sluggishness in employment is that that could help to keep long-term interest rates capped, even push them slightly lower. And it could open the door to the next Fed chairman, who's likely to be Warsh, to even cut rates a couple times. So that's the Goldilocks backdrop we've been talking about for several months now, is improving early cyclical economic data while we're still seeing the lagging employment data remain sluggish. And I think that's a pretty good backdrop for equities. And now today, as we're recording this, the Supreme Court now officially struck down Trump's tariffs. And I think that's a major positive. Yes, he may find other ways to get them back on through the various vehicles that we are all very aware of, but he also may drag his feet in doing that. Let's not forget there's a midterm election coming up, and the number one issue right now in the US economy is affordability. And tariffs and affordability are very much tied at the hip. And so not only is this a positive for equities because lower tariffs means the perception of inflation is likely lower, which could also help depress interest rates, which will provide relief for, again, the biggest macroeconomic issue the economy is facing today. But Trump may also drag his feet because I don't think he wants to do something that appears to be making inflation go up again. So it's going to be interesting next few days and weeks to see how the administration responds. I would imagine, given Trump's long-term obsession with the U.S. getting ripped off with trade, that he's going to put many of these tariffs back on. But again, I think the headlines are probably more important, and maybe in the details, it's not going to be as inflationary as what we had up until today.
So it's probably not the end of the word tariffs and political uncertainty, but it is another good data point for the markets. And I think that's really interesting that you're highlighting how the early signals are green shoots and continue to get better, but it's still a mixed bag. You still have data like employment that may scare a few people. And I think that's so emblematic of every recovery, but also what we're seeing in the markets with certain stocks under pressure. One of the things I saw this week I thought was so surprising was if you ask most people, I think they'd say, wow, tech is really getting hammered. But equal weighted tech is up on the year, running at almost 3%, maybe even higher today, positive, while the Mag 7's getting crushed and cap weighted tech is underperforming. So I think that's really surprised me. I mean, you're 3%, you're talking at double digit run rate for the year. If you annualize that,
Yeah.
that's great performance this early in 2026.
And you've got the small cap technology sector up over 10% this year. I mean, there's just a ton of semiconductor stocks in there that are on fire. And those that are listening, you could track this. There's conveniently equal weighted ETFs. So those of you that are familiar with the equal weighted S&P 500, the ticker there is RSP. Basically for every sector, there's an RSP and then the letter that kind of is associated with the sector. So with respect to tech, it's RSPT. For energy, I believe it's RSPE, for example. So pretty easy to figure out. And as I sit here and we're talking right now, the RSPT is up 4.37% year to date.
Oh, it's even higher than I thought. Yeah. I was looking at yesterday's close. It's pretty incredible. I guess Apple's not the economy and the economy's not Apple.
It's a flip from last year. People were overly optimistic about equities in 23 and 24 and 25. Not that it was a bad year even for the average stock, but the average stock was up far less than we had in the index. And now we're seeing the opposite. And it's almost like people are not recognizing that.
Yeah, Michael, very interesting markets we're in today. Anything that should be on our radar or anything you want to kind of highlight before we wrap it up today?
Yeah, well, I'd say again, our conviction is that we are finally in a broadening macroeconomic backdrop and therefore a broadening earnings backdrop for the first time in almost 5 years. And our message to clients has been to not buy the dip in tech, but to ride the rotation in cyclicals and value areas. We've seen this rotation simply explained by duration. And what I mean by that, think about companies that are, not growing earnings anytime soon, or think of, at an extreme, think of crypto assets that are infinite duration, effectively really weak performing. Companies with great sales growth. So again, Mag 7 has great sales growth, but just not the right macro environment, plus the growing concerns in AI about CapEx, that investors are starting to re-rate those stocks a bit lower. At the same time, we're seeing better, broader data in areas that we haven't seen in 3-4 years. So investors are flocking to shorter duration, whether that's cyclical names or value names. And in fact, one of the best performing strategies this year has been stocks with higher dividend yields. And, at a sector level, one of the best performing sectors, if not the best performing sector year to date, is energy, which tends to have higher yields, dividend yields, and is very short duration in terms of its business. So keep your eye on the ball there. That's the main macro trend that's taking place. But of course, there's going to continue to be headlines and risks that create concerns. And I would say don't let that distract you too much, and certainly perhaps avoid areas where there are secular potential problems brewing, like in private credit, for example. That made some big headlines this week with Blue Owl's sale of some private credit assets, in addition to the freezing of the ability for clients to redeem money from their funds. So the microscope is certainly on that area of the market. We continue to not see that being a systemic problem for equities, but it certainly is an area that has potentially growing risks that investors may just ultimately want to continue to avoid in 2026, particularly when there's other areas of the market that are seeing better data and are cheaper and are not at risk of potential systemic financial problems. So in addition to that, there's news, of course, on Iran, and that's pushed oil prices up recently. And, we know in the last few years, or at least since President Trump's been in office, buying oil on I don't want to say the hope, but the hope of a supply shock has not been a good investment strategy. And given that we have midterms, like I said about tariffs, I would still be very surprised if President Trump were to do something that blatantly pushed up the prices of oil, because again, that's a sure way to not get Republicans voted in the midterms in November. So again, plenty of risks, but we believe the markets will continue to climb the wall of worry, but it's going to be the Davids, not the Goliaths, that are going to be the outperformers this year.
Thank you so much, Michael, and I'll see you next week.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.